Hi, I'm Ben Brundage. I head up the investor relations department here at Crystal View Capital. Today, I'm joined by Matt Ricciardella, our founder. And, we thought we've been receiving some questions here over the past few months from investors and clients. And we thought we'd just sit down and cover some of those things right now, some things that we've heard again and again. And we just want to make sure people are taken care of and we're communicating well. And so, with that, let's just dive straight into it, Matt, if that's all right.
Great.
Well, Crystal View's been around for a little over a decade now.
Yeah.
One of the questions that we get is, what do the next few years look like? If we could look out 5 years from now, what's kind of your vision for the company?
Yeah, I think we continue to grow on this same trajectory that we've grown upon over the past decade. It's been remarkable, breakneck speed, the way this firm has grown. And I think it's all attributable at the end of the day to the culture and the team that we've built. And we brought on some new strategic key hires that I think are really going to propel us to that next level. So over the next 5 years, we're going to continue to do what we do best. That's find great deals, create value across our portfolio, deliver for our investors first and foremost, and go off and do it again and again. So that's what I envision. And I see us being $1 billion to $2 billion firm within the next 5 years if we continue to do what we've done in the past.
Yeah, fantastic. Well, you mentioned some key hires. Who are some of those people? What is that?
Yeah, so we brought on Derek Burgeon as our new COO, who I think is going to make some tremendous positive changes at this company. Formerly, he was with NSA, which is a publicly traded REIT on the New York Stock Exchange. He brings a wealth of knowledge on the storage asset class, which I think translates extremely well over to manufactured housing.
Mm-hmm.
So he's already made some positive, impactful changes that's driven NOI across our storage assets. And he's already in the process of doing that on our parks right now.
Mm-hmm.
So I'm really excited to see what the next 6 to 12 months holds under his leadership as COO.
Yeah, fantastic. Well, you also mentioned acquisitions to come. You were excited about some of these acquisitions.
Yeah.
What are those acquisitions? What are ones that you're particularly excited about?
Yeah. So, look, I'm excited about all of them. As you know, I put a significant portion of my own capital in, so I'm only going to do deals that I'm excited about. And I'm excited about them for different reasons. As you know, we're on the process of closing on a $64 million portfolio deal in the Midwest right now, which I'm extremely excited about. And that's going to be closed in 3 different phases. And our phase 1, I'm pleased to say, is actually going to close, we anticipate, this week.
Yeah.
So that deal is going to drive significant value. The team's already in place to jump in. What we anticipate at this particular park is our ability to grow occupancy and grow revenue. And the team's on standby for the closing, and we're really excited to execute on that one. And the other 2 will be closing very shortly thereafter.
Oh, fantastic. Good to have that here before the end of the year.
Absolutely.
Now, you mentioned making a personal investment into this fund. That's a question that we get time and time again is, do you have skin in the game?
Mm-hmm.
Could you speak to that?
Yeah, absolutely. I have skin in the game, and I have skin in the game for several reasons, Ben, as you know. First and foremost, alignment of interest.
Mm-hmm.
I think there's nothing more powerful than putting your money where your mouth is at the end of the day. We like to say we eat our own cooking. And investors appreciate that. So I have north of $2 million of my own capital in Fund 4.
Mm-hmm.
Collectively across the portfolio, across all of the funds that we sponsor, it's close to $15 million of my own money. So we're going to win or lose together, but we have a vested interest and an alignment. And then secondly, it's selfish reasons. I don't know where I'm going to get a better return than a Crystal View return at the end of the day on a risk-adjusted basis. And we've been able to deliver these returns time and time again. So over time, I'm going to grow my commitments across Fund 4.
Yeah, wonderful. I think it's fantastic that you've chosen to invest under LP terms as well. We hear a lot of feedback from folks who say, okay, it's great. Your manager has skin in the game, but is it under some sort of sweetheart side deal?
Yeah.
And it's not.
No.
With you, it's the same investments that anyone off the street could make in the fund.
That's right. In fact, I would say, we have these different unit classes, as you know, and some investors the Class A investors are even on better terms than I am as an LP at the end of the day. But again, back to alignment of interest.
Mhm.
I think it needs to be done that way. That's the only way to do it at the end of the day. And these other groups that aren't doing it that way, I question their motives at the end of the day. How much capital are they really putting in, you know?
Sure.
So for us, it's really the only way to do business.
Yeah, absolutely. Now you speak about some of these other firms, and we've questioned some of the motives out there.
Hmm.
But we hear from a lot of investors, especially lately, over the
Yeah,
past year or so. Hey, I'm in this other fund, this other investment. My distributions have been frozen.
yeah,
I'm not quite sure where the preferred return is coming from.
yeah.
And that's really not how we operate,
That's right.
right? Our preferred return is from cash flows from operations in our assets themselves.
Yep,
I think that's the only way to do it. And
absolutely.
and you've set up the company that way from the beginning.
Yep.
Could you go back and just talk about maybe some of the performance of the funds and where we're getting those cash flows from?
Yeah, I'd be happy to. I mean, rewind back to Fund One. Most people know that have been invested with us over the past decade. Our returns have been quite extraordinary. In fact, Fund One was ranked by Preqin, which is a third-party rating agency, as at that time the number one performing private equity firm in
Mm-hmm.
the United States. We had returns on a gross basis of 47%
Yep.
on that fund. Fund Two, we're tracking to a high 20s to low 30s
Mm-hmm.
level IRR. Fund Three, we've never missed a preferred distribution, and we're hitting a low 20s level return on that particular vehicle. And Fund Four, we don't anticipate any differently. In fact, right now, we're at a 7.5% cash on cash
Mm-hmm.
return, was our most recent distribution. And I will mention this is a 2023 vintage fund. So that ramp up is extremely fast. We're actually ahead of projections. And I would anticipate we're going to hit 8.5% cash on cash returns
Mm-hmm.
early to mid 2025. And those returns, as you mentioned, Ben, are purely from cash flow from operations, from these particular properties that we own and that we're executing a business plan across. We would never think about making distributions from investors' capital. I was actually astonished to hear that some investors were following that methodology. I think it's unfortunate. And I don't know if investors know that's actually happening. Perhaps they are, perhaps they're not. At the end of the day, that's, again, the crystal view way of making returns and distributions to investors is cash flow from operations. It's really the only
Right.
way.
Right. Yeah, we do think that's the only way. All right. Now, we've talked about in Fund Four the assets that are coming down the pike,
Yeah,
where those distributions are coming from, but there
yeah,
will be a point when we sell those assets.
yeah.
Could you speak to the life cycle of the fund? And as a manager, how do you decide when an asset
Hmm.
is kind of ready to sell?
Yeah, when it's ripe for sale. So, the life cycle for Fund Four, it's a 10-year vehicle.
Mm-hmm.
We've got two 5-year options to extend. With that being said, liquidity events are going to occur during the life of the fund. Let's use Fund Two as an example. It was a $58 million equity offering. That was a 2018 vintage fund.
Mm-hmm.
And through preferred distributions, special distributions, and return of capital, investors have nearly received all of their capital back. We
Right.
still have $120 million of investments in that vehicle, and we're still hitting an 8% preferred return. So it's not as though all the distributions are made at the end. Liquidity events are occurring during the life cycle of the fund. Now, you had asked, when is the right time to wind down the fund? When is the right time to sell particular investments? There's no right or wrong, and I would say that it's more art than science at the end of the day.
Mm-hmm.
And I could tell you this, across the time that I've been the general partner and the manager of these vehicles, if I've had one regret, it's selling investments. Now, it has to be done. Our investors are expecting those distributions. Our investors are expecting us to wind down these funds. We absolutely will honor that commitment that we've made. But I will say this, it's an interesting question. A lot of investors have come to us and said, hey, are returns going down across your vehicles? Because I see these extraordinary returns in Fund One, these extraordinary returns in Fund Two, and then Three and Four seem to be a little bit lower. I think this ties really well into this particular question. Fund one, what we've done successfully and in fund two is when we've sold investments, we've actually rolled those gains into new investments.
Mm-hmm.
And we've executed a business plan again. So this compounding effect has taken place. In our original underwriting across our funds, we haven't really anticipated doing any of that.
Mm.
All of that becomes icing on the cake. So if we're allowed to basically redeploy that capital back into new investments,
Mm-hmm.
I would definitely anticipate seeing returns shake out better than we initially underwrote them in our fund documents.
Yeah. Well, I think that's something that investors can get really excited about. Conservative underwriting on the front end and overperforming
That's right.
for investors.
And liquidity events all the while,
Yes.
just like we did in fund one and two and three. And right now we're doing in three as investments mature. We anticipate that same approach in fund four.
Right. Now, across all of our funds, the asset makeup between MH and storage has changed a little bit.
Yeah.
Could you speak to where we're at with Fund 4 and how we're shaping Fund 4 into the future?
Sure. So, we started Fund 4 more heavily weighted towards storage.
Mm-hmm.
And as you know, there's been a pretty significant shift. Now we're more heavily weighted on the MH side. And we anticipate if we close these pipeline assets, we're probably going to be closer to 75 to 80% weighted on the MH side.
Mm-hmm.
And we couldn't be more excited about that. And the reason for that is, as you know, we believe we're in an affordable housing crisis in this country. And there is unbelievable demand for affordable housing across our communities that we own and operate in. And it's really allowed us to grow occupancy and grow revenues beyond what we initially underwrote.
Mm-hmm.
So we're very excited about this for many reasons. And we're filling a void, frankly. These folks need this housing. We're providing it to them. We're providing returns for our investors. It's a win-win across the board.
Right. Well, we've got such a robust track record, particularly in MH. Could you speak to that track record a little bit? And then we've got maybe a couple RV parks coming down the pike. Could you speak to how we're transitioning and how we're set up for the RV side?
Yeah, the way we've delivered on the MH side, and you know this, and a lot of our investors know this already, but I'll touch upon it. It's finding investments and buying them right. It's building that bond, that relationship with these owner operators. And the way we do this, we're vertically integrated, as everybody knows. We've got an in-house acquisitions team. There's 7 to 8 full-time professionals. They're on the phone every day. They're up in the air. They're going out to meet with these owner operators, breaking bread, having a meal with them, listening to their story. And these owner operators, a lot of times, Ben, they're looking for the best steward for their particular property. It's not always who could write the largest check. It's a situation where maybe their grandparents built the community. And they worked there as a kid in the summer, and they really want to see it go into good hands where the owner is going to take care of that community, take care of the residents. I don't think there's a better steward than Crystal View out there. And it's just about educating them and conveying that message and showing them that, quite frankly. And we've been successful in doing that, and that's allowed us to acquire some really exceptional parks. And this portfolio deal is no different. These are institutional quality assets. And if we didn't have this approach where we were boots on the ground, spending time with these owner operators face to face, going directly to the source, we wouldn't be able to bring these properties into Crystal View. So we're really excited about that. You made a point about the RV parks. We don't have as robust of a background and track record, but it translates extremely well into what we do. As you know, back to that vertical integration, we have an in-house asset management team. We have policies, procedures, systems in place where we've been known to create value, and we've been successful in creating value. Now, those systems are no different on the RV side.
Right.
And I'll give you just a small example. We've got an asset named Olive Branch in our Fund 3. It's an RV park. We're actually performing $100,000 above our underwritten NOI at this point when we initially underwrote this deal back in 2022.
Wow.
So we're really excited about how we've been able to execute here. And we've got some other deals that are potentially going to be going into the pipeline that are no different. Our team has a fantastic capability to create value, and we're going to do that on MH, we're going to do it on storage, and now we're looking at doing it on RVs. So we're really excited about it.
Wonderful. Well, we're excited about what's coming down the pike. Thank you so much for answering these questions today.
My pleasure.
If you still have questions out here, please visit our website, watch our latest fund webinar. That's available for you, where we do a deep dive into Fund 4, the assets that are in there, and then what's coming down the pike. And we would love to chat with you. If you have further questions, if you want to get in the weeds, we would absolutely love to do that. So feel free, check out our website, check out the webinar, and schedule a call with us. We would love to connect with you.